don't envy Chris Derusha jobs. It's too complex and too responsible. On this happy note, I would like to invite Aaron Heller, the host of Defense Matters, a podcast about defense, technology, and more. And I'll ask him to invite the members of the panel to have a discussion about cyber trends in investments.
Hello, well, thank you for joining us. We have an interesting panel ahead of us right now about investments. We're going to talk about the money behind this whole operation. We've got a really good panel to join us here. It's very fitting that we're here in the cyber gathering here in Israel, where an astounding 40% of all cyber investment ends up here in Israel. So it really is a powerhouse, and I'm really happy to bring out our four panelists. The first is Elik Etzion. He's the managing partner of Elron Ventures. Yes, round of applause. Former global CISO at Hapoalim Bank. Our second panelist comes from the States, Seth Spergel. He's the managing partner at Merlin Ventures, a strategic investor with a focus on early stage Israeli cyber. Then we have Yoav Leidersdorf, who's the managing partner of YL Ventures, an early stage cybersecurity focused VC. And finally, the CEO of Discount Tech, Guy Navon. This is the tech banking arm of Discount Bank. So thank you all for joining, and let's get started.
You want to take this one?
I'll take it.
Shift left.
All right.
That's the goal, right?
All right. Okay. So thanks for joining. Thanks for that musical introduction. It's nice to get everybody over here. So like I said, we're going to talk about investments. This is where it all starts, right? So let's take a look back first at 2022. It was an interesting year for the economy in general, for technology in particular. When it comes to cybersecurity, there's a lot of feelings that even though it's obviously affected by the global economy, it also has its own kind of ecosystem, and there's a belief that in some way it's a little bit inured for this, but not entirely. So I want to hear from each one of you, maybe quickly a brief introduction. And for each of you in 2022, what was the highlight of the year that maybe explained this whole thing? So let's start with Elik, and we'll go down the row.
Yeah, so I'll start, generally speaking about the market, not specifically cybersecurity. So I think this was the year of getting back to normal for the tech industry and the software industry. What I mean is that when we look like for the last 2 decades, we saw that like public software and SaaS companies were traded around like 5 to 10x multiple for revenue, and around 2018, for reasons that we don't have time to discuss here, the public market started like favoring and crediting SaaS companies, and we saw the multiples growing like from 5 to 10 to 30 to 50x, okay, x, and it doesn't really have, a financial justification. And this like hotted environment of the public market also impacted the private markets where we investors are operating, and we saw, heated valuations, and we saw those large mega rounds, not only in cybersecurity, generally speaking, and we saw those signs of a tech bubble, okay, like, secondary deals in seed rounds. This is abnormal, and actually 2022, because of macroeconomics, like burst the bubble and brought us back to the new normal, okay? So I think most of us, or some of us, thought the cybersecurity industry is like resilient to the market, and I even heard the term like recession-proof. But along the year, I think we all learned, especially in the public markets, that cybersecurity industry didn't fight like market gravity. And if we looked at the Hack Index is a public traded index of cybersecurity companies. It behaved exactly like the Nasdaq, okay?
So Seth, is cyber recession-proof?
I mean, I think it's more recession-proof than a lot of other sectors, right? If you look at where the public markets are trading, if you look at the valuations of private companies, if you look at what CISOs are saying about their feelings towards budgets, things like that, it's not gotten hit as badly as a lot of the other segments, but it's certainly taken a hit, like we were just saying, right? So valuations are returning to normal. I think they're still a little bit inflated in certain areas. I think Israel still has more money coming into it necessarily than other parts of the world. But it's certainly gotten a lot more normal. And I think we're seeing more of a return to, let's think about what the right way is to run a business, right? We can't just be focused purely on growth, right? There are things other than ARR growth that matter, right? Are we doing this in an intelligent way? But I was reading, PitchBook came out with some research yesterday talking about, what are the segments that are going to be most impacted, right? And nobody thinks cyber is going to be hit as badly as anywhere else. I think 15% of CISOs said that they see cyber as the most resilient of the segments and not one that's going to be significantly cut in their budget the coming year. And, I think that's the problem is not going away, right? So we had Chris up here just a minute ago talking about national cybersecurity strategy coming out in the U.S. hopefully in the next week or so. We're seeing a lot of focus there on, what else do we need to do, and all that's going to continue to drive the need for cyber growth.
Yoav, what's your headline for cyber in 2022?
Those are all really great points. So, I mean, if I just try to add to that, I guess there's a bit of a bifurcation between seed and growth rounds. And Wild Ventures, my firm, we focus entirely on seed investing in security. And so I think the market that we're seeing, at least for our investments, is a little bit bifurcated from the rest. And I have some data that we published in TechCrunch last month. Basically, overall funding for Israeli cybersecurity startups fell by 64% from 2021. Oh, sorry. So I was saying overall funding for Israeli cybersecurity startups fell 64% from 8.8 billion in 2021 to 3.2 billion in 2022. So that's a big drop, 64%. But that entire drop was in later stage rounds and growth rounds. The seed actually increased, seed rounds increased by 65% from 233 million in 22 to 384 million in 21. And the average seed check, or the average seed round, grew from 7 million in 2022 to 9 million from 7 million in 2021 to 9 million in 2022, right? So, and it's not uncommon to hear about $10 million seed rounds that are still being done today. So I think there's a bit of a difference between seed and growth. Why is seed still so strong, going strong, and why are we doing so many more seed rounds is because of our confidence in security. And this is what my colleagues here have said. We work with 120 venture advisors. Virtually all of them are basically saying that there is no decreasing security budgets at all for 2023, right? So most of them are flat. I would say 80-90% are flat. Some are increasing. Some are increasing with inflation. Some are increasing a little more. But essentially, if you're investing at seed and you're looking to exit 7-10 years from now, you're unchanged basically from your behavior last year.
Guy, unlike these three guys, you come from the banking industry, have a little bit different perspective perhaps. What's your take on all this?
Yeah, so at Discontech, we provide banking services for high-tech companies in all stages, also cybersecurity companies. We see around 800 companies a year. And yeah, we saw the huge decline in investment all over the verticals. We need to understand that companies used to have, they were using money for free, almost for free. It was cheap money. Investors, early stage and late stage, told them grow as fast as possible, provide a product in a year, year and a half, and grow as much as possible. And now we are returning to the new normal. You need to have an efficient growth, efficient KPIs, and liquidity is an issue. When liquidity is an issue, your investors tell you, tighten your budget now. And then you see it, as Yoav told us, a differentiation between the early stage companies and the late stage companies. We see a vivid market in the early stage market, in seed market and the A, but the later stage market is in a problem in which means when investors tell the company to tighten the budget, other investors tell other companies to tighten their budget. So there's a vicious cycle that your clients also tightening your budget. So we see ARR growth is lowering down to 10%, 15%, or maximum 20%. It's not 50, 80, or 100%. And companies at later stage now diversifying their finance through debt from banks.
All right, well, thank you. It's nice to get an introduction overview from all of you from your different perspective. I'd like to sort of break it down a little one by one now, a little more in particular. And given what we heard right now, Elik, with the fact that the money is just not flowing as much as it did before, what kind of impact do you think that'll have on the enterprise cybersecurity, especially budgets and et cetera?
Yeah, I think, my colleagues here noted that cybersecurity budgets actually freezed, okay? I was a CISO for like 4 years in Bank Hapoalim, and every year my budget increased, okay? I had a discussion with the board, and everyone understood that we have to increase the budget, and it's not, a single case. Like the last decade, I think in most of the industries, like not financials only. It's in healthcare, it's in manufacturing, it's in media, cybersecurity budgets increased. But I think this is the first year that we can see that most budgets are freezed, maybe some budgets are even decreased. So cybersecurity is not going anywhere. The world is like in a continuous security depth, okay? As long as we have tech, and tech will disrupt industries, we will have cybersecurity. But I think that this year, CISOs will be more like looking, to optimize their security budgets. And what do I mean by that? First of all, you want to see that you get an ROI as a CISO, okay? Return on investment. Usually, we didn't use this term in cybersecurity. It's like a, term in sales, but this term is dominant now in cybersecurity. You want to see return on investment. Return on investment can be, in implementing cybersecurity capabilities that drive your business, okay, that push the business forward. It can be cybersecurity capabilities that, make you complement to regulations, or, even when you see a real threat that is a dominant threat that is not covered by your security plan, so this is also an ROI. But CISOs won't go for a nice to have, like we had in the last decade. They will go only for as a must have. And I think CISOs are not different from any C-level, executive in an enterprise. The CFO is pushing everyone to cut costs. And when renewals come, they will negotiate. They want to cut the costs. And I think that startups, and we say to our portfolio companies, and this is my advice to all startups, think of your pricing model, come with flexible terms, like deferred invoices or any other, tricks to help CISOs buy your product. And from the optimization side, we have a vast network of CISOs. Everyone is reflecting that they are looking to optimize their dozens of security products. Like they want to replace 3 products with 1 product. And I would advise security startups, mostly late stage one, to go wide, not to go deeper. Okay. Because, usually CISOs look for the best of breed, but now I think like the median CISO is looking to cover most of his threats with a minimal
So I want to get in there and sort of ask Seth about that, because your focus is on software that affects the U.S. federal market.
Yes.
And that tends to be usually more insulated than the private sector. Do you agree, or is it different in your field?
I think in some ways, right, for us, this is actually an opportunity, right? Because the federal market tends to be a lot, almost inverse of where the commercial market is. And you see a flocking towards the federal market or the government market in general when the commercial markets start to suffer a bit. So, for us, our focus is on technologies that we think have relevance to the federal market. Now, we're not looking for government-specific technologies, right? We want that commercial applicability. So, our startups are commercially focused. They are still, feeling the impacts of this on their customer set. But we think in the long run, right, to Yoav's point, right, like we're thinking about this in the multi-year sort of view, not is there going to be an exit tomorrow. Federal makes a lot of sense, right? And if I look at the cybersecurity budgets in at least the U.S. federal market, right, since 2021, we've had a 25% growth in the federal cybersecurity budget, right? Just the U.S. civilian market, right, excluding DoD, is $11 billion of cybersecurity spend. So there's certainly a lot of opportunity there, and I think those companies that can figure out how to navigate that, right, and part of our focus is on helping them do that, can use that to balance some of the commercial headwinds.
Now, Yoav, you're focused on early stage investments, and given this market that we're talking about now, it's much harder to get Series A investments. So given that, and this is what we're looking forward to now, what are your recommendations for solid fundraising?
Yeah, absolutely. So I'd love to talk about it from that perspective. We currently have about 8 seed stage companies in our portfolio. Most of them are still stealth, and most of them are very new investments. And we plan to make a lot more in the coming years. If you had to summarize the kind of advice that we give these companies, and I know there's a lot of early stage entrepreneurs in this conference, I would say, first of all, have cash for at least 30 months when you fundraise, when you raise that seed round. So the way we look at budgets has changed from, say, 2021. We're a lot more conservative, meaning we don't expect that A round to come for quite a while. And if it does, great, but if it doesn't, at least we're prepared. We focus a lot more on metrics, especially annual recurring revenues. We have some companies getting to, say, $500,000 in ARR in record speed, and we encourage that because that's essentially what the Series A investors are looking for. So the thresholds, the metrics that the follow-on investors are looking for have become much higher, much harder for the startups to achieve, and we basically just try to drive them to do that. I would say if companies are running out of cash and haven't hit those metrics, we haven't had that yet, but we're expecting that we probably will. We'll say go for those alternative sources of capital. We have a great relationship with SVB. We encourage venture debt. We encourage safes. We've done a bunch of them in the last few months. And delay that event where you have to put a valuation on the company. If you have to raise in 2023, it's not going to be at the multiples that some of these companies have been used to in the past. So try to get that cash to stretch, focus on those customer metrics, et cetera.
Good advice, thanks. Guy, I'm going to ask you, and particularly from your position, you sort of sit at the nexus of the banking and technology and economy. And so we know that over this last few years, Israel has always operated sort of its economy and technology independently from the geopolitical things that are going around. But lately we're seeing, especially since this new government took hold here, the judicial reforms they're trying to promote, we've heard much more outspokenness from Israeli technology leaders, from Israeli economic leaders, that this is going to have a direct impact on the Israeli economy as far as investments. Do you see the Israeli cyber sector and high technology in general being affected by this?
Well, first of all, I prefer not to refer to the political situation in Israel. But from business-wise, I think the cyber ecosystem is not different than other parts or verticals of the tech ecosystem. They are going parallel. Yeah, when you have a technology edge, you will continue irrelevant of the economic position of Israel and the economic macro position of Israel and the political situation. I believe that.
Do you guys agree? Anybody have any input on?
Yeah, I must relate. We at Delaware Ventures are planning to keep investing in the Israeli cybersecurity startups. We believe in Israel. We believe in the Israeli cybersecurity ecosystem. I think it's important for Israel, but it's more important for the world that we export this know-how and capabilities from Israel to the worldwide. So regarding the political dispute, we are keeping on and investing in Israel.
Same, yeah.
Yes, and business as usual in terms of investing. We're not investing in governments. We're investing in people. We're investing in technology and cybersecurity. That Israel is the #2 exporter in the whole world. There's absolutely no reason to change the investment activity.
Okay. So let's wrap up sort of with another roundtable between the four of you guys. We started by looking back at 2022. Let's look forward at 2023 and beyond. There's a lot of investors who are thinking that this year is going to be as bad, if not worse, than the previous year. So how do you think this is playing out in cybersecurity, also in the coming year, but also a little bit more in the medium range, sort of 5 years ahead? Let's start with you, Alec.
Yeah, we can change the direction.
Sure, you want to come from the other direction? Let's come back here.
Thanks. So yeah, our basic scenario is that 2023 will be worse than 2022 in terms of investments. We see many sub-verticals in the cybersecurity where we see dense ecosystem with many, up to 10 companies with very similar product without differentiation, without a technology edge which is different than the others. This is a problem that I believe that the market will solve through M&As or other options. So we believe 2023 will be the year that the market will clean itself.
Yoav?
You know, people seem to have the impression that 2021 was normal, and so 2022 is like a disappointment. But 2022 was great because it was similar to 2020, right? And so 2021 was the actual anomaly. And so if you thought that 2021 was a normal year and you kind of indexed to that, good luck. That's just not coming back ever, right? So 2023, I feel might be somewhat similar to 2022 in many ways. I don't think it changes anything that we do on the seed end of the spectrum, especially given the long time horizons. Of course, we have to be very careful about follow-on rounds and everything I mentioned earlier in terms of metrics and making the cash last longer. So those are very tactical, but we're certainly very bullish and just keep investing.
Yeah, I think similar view, right? There is going to be, like we touched on already, a bit more rigor around how people are running companies, right? And it is a little bit harder to raise, but even in the latter half of 22, even as things started suffering, right? You saw that the really strong companies were still able to do it, right? And Yoav mentioned earlier, we bet on people, right? And the right people can still lead the companies and convince investors to invest in them. And I think from an investor perspective, right, this is healthy, right? We get rid of some of the excess cash in the market. We have valuations that reflect what companies are actually able to do, right? And we set realistic expectations for them. We ask them to work on how do you properly allocate that money? How do you properly grow a company in a healthy way? And I think by the end of 2023, we're in a pretty good spot with a lot of those companies going forward.
Yeah, I would say, because 2023 is still, the transition between the upcycle that we had in economy and the down cycle. So it's quite a risky year. And I saw a lot of startups in 2022, like cutting their burn. It was also advice from investors in order to get the 30 months. But it's really only a tactical, way of doing because it's like dying slowly. Eventually, you need to meet the capital market. You have to raise capital. You have to put capital into work and to grow your company. So in 2023, startups that did, cut the burn in 2022 will have to meet the market. And I think that investors and founders have to adjust themselves to the new market conditions. And maybe the top quartile startups with the good metrics, it's not only you have the ARR growth, it's also, the efficiency, the gross margins, the low COGS, the CAC to LTV. We want to see efficiently growing. So those startups that are doing great will raise in up rounds, but I believe most startups will do flat rounds, maybe even, down rounds, and the flat round is a new up round. So I think founders and investors have to adjust themselves. And I would advise startups that are not doing so well to execute on a dual strategy, try to grow the company and raise funds if needed, but also build the relationships and partnerships that maybe they already have or new ones with potential M&A buyers. We didn't talk about it in this panel. The M&A market is very active. Like in 2022, we had more than 200 cybersecurity M&As. Okay, it's quite rational because all the M&A buyers and PEs and strategic buyers are seeing that they can buy companies in low single-digit multiples. So sometimes for a startup that is not doing so well, it's a good decision, like, to go for an M&A in this stage and not like, to mess his cap table and try to go forward. For some startups, that's the right choice, I think.
Great. Well, thank you for all of you for your input. Very interesting. So we have to wrap up now. So I want to thank Eli Ketzion, Seth Spergel, Yoav Leidersdorf, Dr. Guy Navon. Thanks for all your insight. I hope you found it interesting, and I hope you all could, if you're interested in these kind of things and more, be sure to follow. I have to have a shameless plug at the end, right? Follow is Defense Matters, anywhere you get your podcasts. So we'd be happy to have you listening and watching. So thank you very much.
Thank you.